Welcome back to the Deep Dive, your shortcut to being truly well-informed. We take stacks of information, sift through that noise, and pull out the most important nuggets for you. Today, we're doing a custom deep dive into the latest financials for eClerx Services Ltd. They're a global specialist services firm. So our mission here is to really unpack their first quarter fiscal year 2026 results. These are unaudited for the period ending June 30th, 2025. We've got the official earnings presentation, the press release, the board meeting outcome letter, basically a whole pile of data.
Yeah, quite a bit to go through. And this dive, it's not just about the numbers themselves, right? We want to connect those dots, between revenue, profitability, how efficiently they're operating, even what they're doing with their people, their talent strategy. It helps us understand the company's health, maybe where it's heading, see the bigger picture.
Okay, let's unpack it then. Looking at those headline numbers for Q1 fiscal 26, what immediately jumps out? Anything particularly significant?
Well, for the quarter ending June 30th, total revenue was INR 9,451 million. What's interesting is the growth. It's up a solid 17.7% year-over-year YoY, though quarter over quarter, QoQ, it's a smaller bump, just 3.1%. And their operating revenue specifically. That hit INR 9,346 million. That's up 19.5% YoY in rupees, which in US dollars translates to about 17.1% growth. So USD 109.2 million. Decent top-line growth there, especially YoY.
That is solid top-line growth, YoY. Okay, so revenue looks healthy year over year. What about profitability for the quarter? Any surprises?
Yeah, the profit side shows some, let's say, interesting shifts. Net profit came in at INR 1,417 million. Now, that's up a strong 26.9% compared to the same quarter last year. Good news there. Similarly, EBIT earnings before interest and taxes, that was INR 1,977 million, up 27.1% YoY. And EBITDA, INR 2,346 million, also up 25.3% YoY. So looking back a year, profits are definitely stronger.
I did notice looking through this, some of those profit growth numbers were actually negative compared to the last quarter, Q4. What's going on there?
Exactly. That's the key thing to pick up on. While that YoY profit growth is really quite robust, there was a QoQ decline. Net profit down 6.9%, EBIT down 5.6%, and EBITDA down 6.3% compared to Q4 of fiscal 25. So it definitely raises the question, what caused that dip from the previous quarter?
Right. And for you, the listener, maybe an investor or just someone tracking this, how did that translate into earnings per share, the EPS?
Good question. Basic EPS for Q1 FY26 stood at INR 30.2. Now, that is a healthy increase from INR 23.1 back in Q1 of FY25. So it shows that growth in earnings per share on a yearly basis is still happening, even with that recent quarterly dip in net profit itself.
Okay, so this brings us to margins, which feels pretty crucial for understanding that QoQ profitability dip you mentioned. What are the margin percentages telling us?
All right, the margins give us more context. EBITDA margin for Q1 was 24.8%, EBIT margin was 20.9%, and the net profit margin landed at 15.0%. Now, compared to Q4 FY25, the previous quarter, these margins did see a decline. EBITDA margin down 250 basis points, so 2.5%. EBIT margin down 194 basis points, and net profit margin down 161 basis points. But interestingly, like the profit numbers, they were actually slightly better than the same quarter last year UI. But that QoQ dip is the main story. So what is the story behind that quarter-on-quarter squeeze? Is there a specific cost really driving this? Absolutely. And the company's pretty clear about it. If we connect this to the bigger picture, the earnings presentation explicitly notes wage increments effective 1st April 2025. And you could see it in the P&L comparison. Delivery and support employees cost. It jumped up. Went from 51.3% of operating revenue in Q4 to 54.7% in Q1. That's a significant increase. It's clearly a major factor, probably the main factor in that margin compression quarter over quarter. They invested in their staff. There was also another note about additional funding to gratuity trust in Q1 FY26. That's like a one-off top-up to employee benefit funds, which adds to costs in that specific quarter. And one other small point, staff utilization for the delivery teams dipped slightly QoQ, down to 72.8%. So maybe a tiny bit less efficient use of staff time, but the wage cost is the big one.
Okay, so that investment in talent, the wage hikes clearly hit the short-term bottom line. What does this tell us about their wider strategy around people and headcount?
Well, the total headcount at eClerx reached 20,385 people as of June 2025. And importantly, their delivery headcount alone is up 15% year over year. So they're definitely still hiring and investing significantly in their workforce, which usually signals they expect continued growth or are gearing up for it. It aligns with those wage increases.
That's a pretty big jump in headcount. Was there anything else on the talent front? Maybe surprising or positive, especially given those investments?
Yes, actually, and this is quite fascinating. The offshore voluntary attrition rate, employee turnover, basically. It saw a really notable decrease, down to 17.6% in Q1 FY26. That's way down from 24.3% in the previous quarter, Q4 FY25.
Wow, that's a big drop.
It really is. It suggests much better employee retention, which is, a key sign of operational health. And it saves costs in the long run, hiring, training. It almost makes you wonder if those wage hikes are already helping keep people happier, right? Improving morale, maybe.
That's a great point, a positive side effect.
Definitely. And they also mentioned that women employees make up 39.3% of their workforce, so a nod to diversity there, too.
Okay, moving to the revenue side of things. Where's the business coming from? Which industries and geographies are driving that top line?
Sure. Their industry mix looks pretty consistent. BFSI, that's banking, financial services, and insurance, it's still the biggest chunk, 43.2% in Q1, followed by CMT communications, media, and technology at 25.4%. They seem to be their core areas. Geographically, North America continues to be absolutely dominant. Its contribution actually increased to 79% in Q1 FY26.
79%.
Yeah. Europe is next at 15%, and the rest of the world accounts for the remaining 6%. So very heavily weighted towards North America.
And what about their client concentration? How reliant are they on their biggest customers? Is that changing?
Client concentration seems fairly stable, actually. The top 10 clients brought in 63% of revenue in Q1, which is, concentrated but consistent for them. It shows deep relationships, but also, yes, a certain reliance. On the growth side, revenue from those strategic top 10 clients grew nicely, up 19.3% YoY. And their emerging clients, the ones over $500,000 annually, also grew well, 19.1% YoY. So they're growing with both big and mid-sized clients.
That sounds positive.
It is, mostly. Though it's worth noting the category they call emerging others, likely smaller clients, actually saw a 6.8% decrease in revenue YoY. So maybe a bit of a focus shift towards nurturing those larger accounts. Could be.
Interesting detail. And did they mention new deals signed? What's the pipeline look like?
They did. The annual contract value, or ACV, of new deals signed in Q1 was reported at $32.3 million. That excludes their CLX consulting arm. So that represents a decent pipeline of new business coming in to fuel future growth.
Good to know. Now, shifting gears slightly to financial health, how's their cash position looking? Can they support these investments?
Oh yeah, they maintain a very strong cash position. Cash and cash equivalents stood at INR 10,205 million at the end of Q1. That's over 10 billion rupees. Their net operating cash flow for the quarter itself was INR 223 million. So plenty of cash on hand gives them a lot of flexibility.
And shareholder returns. I know dividends aren't usually a Q1 thing, but anything mentioned.
Right. Dividends are typically proposed with full-year results. But they did reference the dividend proposed for the previous full year, FY25, which was INR 1 per share. So while it relates to last year, it shows that returning cash to shareholders is part of their ongoing financial strategy, supported by that cash position.
Makes sense. And given that huge North American presence, currency fluctuations must be a constant factor, right? How do they handle that risk?
That's a really important question for a global business like this. And yes, they actively manage it through hedging. They reported total outstanding hedges of about $248 million at an average rate of INR 87.18 per dollar. And these were all executed as 100% forwards, basically locking in exchange rates for future U.S. dollar revenues. It reduces volatility. We also saw something called revaluation income under their other income. That's basically just the accounting impact of currency rate changes on their foreign assets and liabilities. It can swing around a bit based on U.S. INR or EUR movements.
Okay, so pulling this all together then, looking at the full picture of eClerx Q1 FY26, what are the key takeaways for you, for someone trying to get informed here?
Well, if we connect all the dots, eClerx shows really strong year-over-year growth, both top-line revenue and bottom-line profit. That suggests demand for their services remains pretty robust. Now, those quarter-over-quarter dips we saw in margins and profit, they seem very clearly tied to deliberate strategic investments in their people, primarily those wage hikes, plus that one-off gratuity funding. It doesn't look like a fundamental business slowdown, more like a planned investment phase. And crucially, that big improvement in attrition, the drop in staff turnover, that's a really positive sign for their long-term operational health and efficiency. Suggests those investments might already be paying off in retention.
That's a great distillation. Yeah, it really does frame it as a quarter of sort of deliberate investment betting on future growth and managing those short-term costs for longer-term gains. Okay, so here's a final provocative thought for you, our listener, to chew on. How might eClerx continue to balance these necessary ongoing investments in its workforce and capabilities with that constant need, that pressure to expand profitability margins in the coming quarters? What operational tweaks or maybe big new client wins should we be looking for that might really shift this dynamic and prove their strategy right?
Indeed. Finding that balance, that sweet spot between investing for growth and driving efficiency. That's the ongoing challenge, isn't it? The next few quarters will certainly be revealing.
Absolutely. Well, thank you for joining us for this deep dive into eClerx. We hope this gave you a clearer, more insightful understanding of their latest results. Keep exploring, keep questioning, and we'll see you on the next deep dive.